Welcome back to the Energy Signal Podcast, episode number 6, your weekly roundup for the latest trends, policies, and market movers shaping the U.S. global energy landscape. I'm your host, Josh Lefebvre, joining you from the energy capital of the world, Houston, Texas. We are recording this episode today on Sunday, September 7th, 2025. In today's episode, we'll be discussing why oil dropped 3% while gas ticked slightly higher and what that means for jobs in the oil patch. ConocoPhillips and Halliburton both slashing thousands of jobs across the U.S. as prices slump. India defies the U.S. and continues to buy cheap Russian oil despite the high sanctions. Russia's new oil pipeline route and what that means for China's energy future. And then finally, Ørsted is fighting back and they're actually suing Trump over its halted offshore wind project. This episode of the Energy Signal Podcast is brought to you by StageTracker AI, the real-time frac intelligence platform that's powered by AI agents that help engineers and operators stay ahead in the frac game. Whether you're trying to optimize pump schedules, reduce NPT, or benchmark crew performance, StageTracker gives you the live view of what's really happening, stage by stage. No more waiting on the post-job reports to know if you're behind. Learn more at stagetracker.ai because every minute counts on the job. On now to commodities. West Texas intermediary oil prices, they fell an additional 3.3% last week from $63.94 down to $61.97. The drop was led largely due to a weak U.S. job report last week that really dimmed the outlook for future energy demands. On top of that, OPEC is expected to meet yet again this weekend, where it's rumored that they are expecting to continuously increase the supply. So historically, when oil drops this low, we begin to see some major layoffs in the industry, which we're going to talk about in the next segment. On the other hand, gas, the Henry Hub gas index, it actually came up slightly from $2.97 to $3.03, a 2% increase. On now to the big U.S. energy stock players. Exxon Mobil, ticker symbol XOM, they actually fell 4.34% from $114.18 down to $109.23. Chevron, ticker symbol CVX, they also fell from 160.48 to 153.66. They fell by 4.25%. Again, as you're seeing, there's this steady decrease amongst these big players, but it's worth noting that Chevron is actually up 12% over the last 3 months, and it's actually outperforming all of its peers and the S&P as a whole. And this, of course, is driven by their continued investment into the Permian, better technology for increased production, and of course, the recent acquisition of Hess, which gave them a large stake in the Guyana's Starbrook field. ConocoPhillips, again, another one. They fell from $99.10 to $92.95, a 6.21% decrease, much bigger than the others. And this likely had to do with ConocoPhillips cutting off 20 to 25% of their workforce. And we'll cover this in the next segment. But usually when, a company announces layoffs, we sometimes see an increase in the stock, but this is not the case. I think what we're seeing is that this has nothing to do with company fundamentals. All 3 of these companies are, they're very well run, but they're all so closely tied to the price of oil dropping, which that's just how it is in this sector. On to U.S. deals and drills. So our biggest story of the week is that Houston-based ConocoPhillips, it announced that it will cut 20 to 25% of its workforce. The company has about 13,000 employees globally, so this could impact anywhere from 2,500 to 3,500 of their employees, with most layoffs expected to be completed by the end of this year. On that news, shares dropped 4.5% in the afternoon where the announcement was made. In addition to the layoffs, there's also said to be a new management structure that was put into place by Boston Consulting Group. The program is targeting to save somewhere in the range of $1 billion a year. Now, of course, this has a lot to do with falling oil prices, rising costs. Those are said to have had the biggest effect. CEO Ryan Lance told his employees in a town hall, and I quote, "I fault myself for not paying more attention," on that news. Next up, Halliburton also announcing major workforce reductions, with layoffs spanning several weeks and hitting at least 3 divisions, where 20 to 40% of staff were cut within those specific divisions. No specific numbers have been released yet. But again, this comes as crude prices have continued to fall more than 10% just in 2025 alone. And this is putting specific pressure on these service companies, along with the rising costs and the volatility of the demand. Halliburton has close to 50,000 employees and has previously warned of this declining revenue, right? So this is no surprise to them. And they actually posted a 33% profit drop in Q2, right? From Q1, where very profitable, down 33%. CEO Jeff Miller told analysts that the oil field service market outlook has deteriorated sharply, with weaker demand in North America, among many other national oil companies. So this is all normal from what I understand, right? In the oil and gas industry, things are very cyclical. When the price of oil and gas is high, they start hiring like crazy. Whenever the price of oil falls, they start pulling rigs, they start letting people go. So I guess it's a matter of how long will this last. And the biggest thing is that yes, they're cutting jobs, and yes, they usually bring them on when things get better. But with all of this technology and all of this AI, it makes me wonder that whenever things do start to get better, are they going to bring back that workforce, or could it just continue to decline over time? This week, I'm launching a brand new section called Energy Geopolitics. There is no doubt that oil and gas and the energy sector as a whole plays a major factor in just general geopolitics, right? Wars are started, wars can be ended, escalated, all based on energy and how that's transferred from one country to the next, whether it's importing, exporting. So it's only natural that we cover this. And of course, our biggest story of the week is that India has stated that it will continue buying Russian oil despite U.S. tariffs. India's finance minister stated that there is just simply major cost advantages to buying this Russian oil despite these tariffs. India is, of course, the world's 3rd biggest oil importer. Now, the Trump administration, as we covered, has imposed a 50% tariff on Indian goods, arguing that India's purchase of Russian oil continues to fund Moscow's war in the Ukraine. On top of this, Prime Minister Modi participated in a China-hosted summit with Putin and Xi this last weekend, which signaled India's deepening ties with Russia and China, which is a scary thought. Meanwhile, U.S. and India trade talks have pretty much completely collapsed. Our other big story is that the Russian state gas giant Gazprom, they're pivoting to China as its main buyer, as it slowly, actually I shouldn't say slowly, very quickly loses out on all of its European exports. The proposed Power of Siberia 2 pipeline, which has been in talks for a very long time, this could actually deliver an additional 50 billion cubic meters of gas per year to China from Russia through Mongolia. This pipeline would give China options to hedge against future reliance on U.S. liquefied natural gas. At this point, there hasn't been agreed upon price for what it would take to build this new pipeline, but it's stated that the project could start as early as 2030. Now, based on both these stories, there just seems to be a massive convergence between Russia as a major supplier of gas to China and to India for oil sales. So this is basically creating this shared financial interest between these 3 countries. This very well could be today's version of an Axis alliance forming, right? Maybe it's not a formal alliance yet, but this is a growing economic interdependence among India, China, and Russia that is signaling a shift away from Western dominance. On to renewables for the week. So, Danish offshore wind developer Ørsted, along with Rhode Island and Connecticut, all filed lawsuits against the Trump administration over its stop work order, which basically halted the nearly finished Revolution wind project. We've been covering this story for a few weeks, so it's no surprise that we ended up here. In fact, I was totally expecting this. The project was 80% complete, with 45 of the 65 wind turbines installed before being suspended. And this basically put an additional $1 billion at risk. Now, these delays could push the project back by at least a year or potentially lead to cancellation of the project as a whole. The lawsuit argues that Trump's decision here was unlawful, it was baseless, while the halt threatens to derail Ørsted's broader financial plans and the region's clean energy supply goals. So this is obviously in line with what US President Trump has said around repeatedly criticizing wind energy as ugly, unreliable, and expensive. And I mean, take that as you will, but I think there are bigger things at play here that might be going on behind the scenes. So that pretty much wraps up our episode for the week. Really, there's just so much going on in this industry right now, right? It's almost playing out like a movie. On one hand, you have oil and gas prices dropping throughout the US to very, very low numbers, to the point where we're starting to see massive layoffs. But then on the other hand, energy demands have never been greater. And it just really shows you that there's so much more at play, right? OPEC continues to increase supply despite the demand maybe just not being there. And, record output numbers for oil right now. And it's interesting to see how the US is playing its cards. It's putting these sanctions on countries that are buying Russian oil. It's trying to end the war in Ukraine without actually sending troops there. So it's just interesting to see how oil can be used as leverage for different geopolitical issues. And it'll just be interesting to continue to see how this plays out. So, you know what? Until next week, continue to tune in. I'm Josh, your host. This is the Energy Signal Podcast, signing out.